Good morning, judges and fellow investors. We're a team of high school students from Vietnam National University Ho Chi Minh High School for the Gifted, and today we are presenting our stock analysis report and recommendation on Goldman Sachs, the vampires with. In short, our recommendation is sell. We'll explain why in the next 10 minutes.
We talk about the company overview. So Goldman Sachs is a financial institution that founded in the 1869 and has three primary segments. The first one is about the global banking and market, where they are focused on the market making activities and some service like the advisory service like M&A consultation. The second segment is about access and wealth management, where they will preserve and grow the capital of clients. And the final segment is about the platform solution, where it offers the financial technology service like the banking transaction or the credit card for users.
Okay, this is investment thesis, where they come and sell action for GS stock at the target price of $812.50. We have four reasons for that. The first one is about its no erosions and lack of revenue diversification. You know that GS have the top one position at M&A consultation. However, in this kind of service really fluctuate because it depends on economic cycles. So that's why GS tries to expand to the other markets like the retail banking and the flow trading market. However, they lose. They cannot outperform the other competitors in these kind of markets, so they have a low position. The second reason is about its financial performance. When we observe that their revenue in this year is increased not by the growth expansion, but it's just by the cut cost strategies. And the third reason is that it have a negative free cash flow in 2024. And the final reason is about its overvaluation. When we observe that is have a higher PE, it trade at higher PE, while they have a negative 1% revenue contraction, and their net margin also lower than the median numbers of the sectors.
Well, next is the GS market share. So at the global banking and market, you guys can see that the GS have a top one position at M&A advisory and ECMs, but they have just ranked at 6 when it comes to the debt loans market. So this difference can explain by that the M&A and ECM market, they just demand the intellectual capacity on ability. So, and this kind of ability is the core strength of GS, as I will analyze in the next part of competitive positioning. Next, we talk about the asset and wealth management. So I just want to tell you guys that in this kind of market, they focus on the segment of high risk person, high risk individuals, because this can have them extract the highest value on each client, and they just focus on this kind of segment and try to expand their market share at this kind of segment. And we talk about the platform solution. In this slide, I want to say that right now they give up the credit card loans, and they focus on the transaction banking because it offers high margins and low risk that it can synergize into its existing corporate systems. Now we turn to the competitive positioning. First, we rate GS as the narrow moat. Well, as I said before, GS has a high talented human resources to offer high intellectual service like M&A advisory and IPO consultation. However, this moat erodes by first, its core business model is unsustainable when it relies so much on economic cycles. Second, it has poor competition in retail banking and flow trading market. The main reasons why because just about the model when GS is an investment bank which don't have a normal consumer network like GBM and not technology focused like the financial non-bank institution. And the final third endgame will increase the cash reserve for a traditional bank, so it will limit the revenue of GS.
Breaking down the firm's revenue architecture, as you can see from this flow, Goldman Sachs essentially operates as three distinct businesses. They are global banking and markets, which is the engine for the firm, asset and wealth management, a steady and fee-based stabilizer, and platform solutions or their consumer fintech attempt. On the surface, these flows look substantial, but numbers can be deceiving. This brings us to the hard financials. This is where the harsh reality is shown. If you look at the top line, revenue has effectively started and declined, contracting by 1% in the last period. Even more concerning is the cash flow. Look at the free cash flow line. It remains in a persistent deficit. We are looking at a company that is heavily skewed towards debt and struggling to generate organic cash. Yet, despite shrinking revenue and negative free cash flow, the relative valuation at the bottom shows otherwise. The stock is trading at a multiple of 18.1. That is a 61% premium over the sector median. The market is pricing Goldman Sachs as a high-growth stock, but the data shows a company with shrinking growth rates and a massive valuation premium that simply isn't justified by the fundamentals.
GS. So this is our valuation process. We apply both the compatible company analysis and the discounted cash flow method to derive our final target price. And this final target price is based on the range of the two valuations obtained from the two methods. So we take the relative value and intrinsic value to come up with the final target price at $112.50. So briefly, we observe that the stock currently trades at a significant premium at 18.1x PE versus the sector median of 11.2x, which we view as an unjustified given the firm's negative revenue growth at -1% and persistent cash burn. Therefore, our valuation corrects this pricing disconnect.
Since we recommend a sale, we must address the upside risks, the scenarios where the stock could outperform our target. First, a cyclical resurgence. If the global economy expands faster than expected, M&A and IPO activity will surge. This would flood Goldman with advisory fees and invalidate our bearish thesis on their growth. Second, wealth management execution. If management successfully divert to a more durable revenue stream, the market will reward them with a higher valuation multiple, driving the stock price up. Third, strategic initiatives. We cannot discount their ability to innovate. Unexpected success in new tech partnerships or platform strategies could drive growth significantly above consensus.
Next, we talk about management in GS, and we really appreciate this team because, first, recently they have good strategic pivot when it is from their consumer and retail banking to refocus on their intellectual core strength and expand the asset wealth management segment. Second, they also have maintained the capital allocation, which focus on shareholders with sustained dividend growth. And finally, I think they have the skin in the game because they have a high insider ownership and the pay for performance mechanism.
On the ESG front, the visual on the left shows a sustainability maturity score of just 57%, which lags behind industry leaders. Despite being a global powerhouse, Goldman Sachs ranks 259th in finance for sustainability. For the environment, Goldman acts as a laggard in the energy transition. They remain a top global financier of fossil fuel expansion, and recently paid a $4 million SEC penalty for greenwashing, effectively failing to follow their own ESG investment policies. For society, they face systematic cultural risks, that is, gender discrimination, evidenced by a $250 million settlement for gender bias and declining employee satisfaction due to rigid policies. And for governance, leadership incentives are misaligned, executive pay is rising while profits are falling, and the 1MDB scandal continues to hang over the firm as an unresolved liability. The fundamentals already do not support the current price, let alone a 60% premium and the unsustainability.
Now we move to the AI consideration. So first, I want to talk about opportunities. First, GS can use AI to produce code, automate testing, and reduce the cost of OPEX. Second, AI helps them to do the boring tasks so they can focus more on important tasks like their cost strength of intellectual service. Third, you know that GS have the top experts, so they can use AI to synthesize and systemize their information, the special information from those experts to create the unique market insights, the deal comparables, and skillful analytic tools for clients. Fourth, in asset and wealth management segment, AI also enables the firm to analyze client risk appetites and portfolio composition in real time. Finally, with the support of AI, GS can process millions of data points, the millions of unstructured data points to quantify the physical and transaction risk. This allows the firm to price access more accurately and filtering out the greenwashing noise to capture high-quality ESG flows. About the risk, first, if an AI model provides flawed advisory data to a client, the reputation damage would be immediate and severe, potentially triggering the liability claims. Second, but actors are simultaneously using AI to launch more sophisticated ultimate cyber attacks. Third and final, some global regulators can tighten the scrutiny to financial AI, so there will be a risk of the regulatory fragmentation. This is the end of our presentation. Thanks for watching.